Topic examines best practices and challenges associated with liquidity transfer pricing, LTP, an internal financial management framework used by banks to allocate liquidity costs, benefits, and risks across business units. Liquidity transfer pricing helps institutions incorporate funding and liquidity considerations into pricing decisions, performance evaluation, and strategic planning. Through this system, business units generating funding surpluses receive credits, while units consuming liquidity are charged corresponding costs. The topic emphasizes that LTP improves transparency and encourages responsible liquidity usage within financial institutions. Effective liquidity pricing frameworks support balance sheet stability by aligning business incentives with the institution's overall liquidity risk management objectives and regulatory requirements. A major best practice in liquidity transfer pricing involves accurately reflecting the true cost of funding and liquidity risk associated with different products and business activities. Institutions should incorporate factors such as funding maturity, market liquidity conditions, collateral requirements, and contingent funding exposures into transfer pricing calculations. Long-term illiquid assets generally require higher liquidity charges because they increase funding risk and reduce balance sheet flexibility. Conversely, stable retail deposits and long-term funding sources may generate liquidity benefits for the institution. The topic explains that robust liquidity transfer pricing frameworks improve resource allocation by ensuring business decisions reflect the economic impact of liquidity consumption and funding stability across the organization. The topic also highlights operational and strategic challenges involved in implementing liquidity transfer pricing systems effectively. One major challenge is determining appropriate pricing methodologies that accurately capture liquidity costs under both normal and stressed market conditions. Liquidity conditions can change rapidly, making pricing assumptions difficult to maintain consistently over time. Institutions must also balance simplicity and accuracy because overly complex models may reduce transparency and operational effectiveness. The topic explains that disagreements may arise among business units regarding transfer pricing allocations, particularly when liquidity costs significantly affect profitability measurements. Strong governance, clear methodologies, and regular model reviews are therefore essential for maintaining credibility and consistency within liquidity pricing frameworks. Another important challenge involves integrating liquidity transfer pricing into broader risk management and regulatory frameworks. Financial institutions must align liquidity pricing models with Basel III requirements, stress testing assumptions, and internal liquidity risk appetite frameworks. Transfer pricing systems should encourage stable funding structures, discourage excessive maturity mismatches, and promote prudent liquidity management practices throughout the organization. The topic emphasizes that poorly designed liquidity pricing systems can create distorted incentives, encouraging business units to pursue short-term profitability while increasing long-term liquidity vulnerabilities. Effective implementation therefore requires close coordination among treasury functions, risk management teams, finance departments, and senior management oversight. Topic also focuses on different approaches to liquidity transfer pricing and the pricing of contingent liquidity risk. One common approach is matched maturity transfer pricing, where liquidity costs are allocated according to the maturity characteristics of assets and liabilities. Longer-term assets typically receive higher funding charges because they require stable financing over extended periods. Another approach incorporates market-based funding spreads and liquidity premiums reflecting prevailing market conditions and institutional funding costs. The topic explains that transfer pricing methodologies should account for both contractual and behavioral characteristics of financial products because customer actions may significantly affect liquidity stability under stress conditions. The topic concludes by examining contingent liquidity risk pricing, which addresses potential future liquidity demands arising from off-balance sheet commitments and uncertain funding exposures. Contingent liquidity risks include committed credit facilities, derivative margin calls, guarantees, and customer withdrawal behavior during periods of market stress. Pricing these risks appropriately ensures business units recognize the potential liquidity costs associated with contingent obligations. Institutions use stress testing frameworks and scenario analysis to estimate the likelihood and severity of contingent funding pressures. The topic emphasizes that incorporating contingent liquidity costs into transfer pricing improves institutional resilience by encouraging prudent product design, balanced funding strategies, and stronger alignment between profitability objectives and long-term liquidity stability.